Welcome, everyone. Today, we're diving straight into the stock market's ultimate psychological test. You see, the market isn't just some giant, cold calculator. It's a living, breathing, emotional machine. We're going to learn exactly how to read those emotions so you can navigate market cycles with absolute clarity.
Okay, let's dive right into this. Studies consistently show that over 80% of individual investors actually underperform the broader market. But why? It's not because they aren't smart, right? It's not because they don't do their research or put in the work. The root cause is completely emotional. It's because the twin forces of greed and fear literally force them to do the exact opposite of what they should. They get super excited and buy when prices are at their absolute highest, and then they completely panic and sell when prices hit rock bottom.
And this brings us to the philosophical anchor for our entire explainer, beautifully summed up by Warren Buffett. Be fearful when others are greedy, be greedy when others are fearful. I mean, it sounds incredibly simple, doesn't it? But here's the reality. Actually going against the crowd is a massive psychological barrier. When the market's booming, everyone you know is making money. The news is relentlessly positive. It feels completely wrong to be fearful. And conversely, when the market crashes and headlines are basically apocalyptic, buying feels like stepping right in front of a speeding train. But this exact mindset is the blueprint for separating the wealthy from your average investor.
Section 1. The cost of emotion. Buying euphoria and selling panic.
Here's a really profound truth about the stock market. Maximum risk is usually disguised as maximum safety during periods of euphoria. When the market's at its absolute peak, everyone's optimistic. The crowd confidently jumps in here, literally paying the worst possible price. On the flip side, maximum opportunity is disguised as maximum danger. We call this capitulation, the absolute bottom. This is when the pain is just so great that the last desperate sellers finally throw in the towel, which is exactly when the smart money is quietly stepping in and buying.
So if we know that euphoria and capitulation are the most critical turning points in the market, it begs a really important question. How do you measure fear and greed in real numbers? How do we take abstract psychology, like feelings of panic or extreme overconfidence, and turn that into objective, mathematical data that we can actually pull up on a chart?
So the crucial point is we use the VIX. The VIX, officially the CBOE Volatility Index, acts as the market's ultimate fear gauge. It basically measures how much volatility traders expect to see in the S&P 500 over the next 30 days. And it doesn't do this by just polling people, it does this by tracking actual money, specifically options market activity. It tracks exactly what traders are doing with their capital when they're trying to protect their portfolios.
To make this perfectly clear, think of it like this. On the left side, when traders are scared of a market crash, what do? Well, they buy insurance, options contracts. When the demand for that insurance goes up, the VIX rises. Now on the right side, when traders are completely complacent, when they think the market's just going to keep going up forever, they don't bother buying insurance. And because they aren't buying, the VIX falls. It's a direct, mechanical reflection of trader anxiety.
Moving on to Section 2, reading the fear zones and decoding the VIX levels.
Now, what's really interesting about these numbers is the cognitive dissonance we see as we go down the table. A VIX below 15 means extreme complacency. You should probably be a bit cautious because the market might be overheated. 15 to 25, that's just business as usual. 25 to 35 means elevated fear. You definitely want to watch closely because corrections are likely happening. But look at that bottom row. When the VIX spikes above 35, we enter the panic zone. Literally everything inside you is going to scream at you to sell. But the data tells us this is historically near a significant bottom, and your actual move should be to prepare to buy.
Section 3. History's ultimate buy signals. Let's look at why the proof is in the data. This is where the magic really happens. Look at these three massive historical events. Every major VIX spike in history was followed by significant market gains over the next 12 months. During the 2008 financial crisis, the VIX peaked at an astonishing 80. If you had bought the S&P 500 that exact week, you'd have seen a 60% return over the next year. In 2020, during the COVID crash, the VIX hit 65. The 12-month return, plus 70%. Even in 2022, during those aggressive Fed rate hikes, the VIX hit 38, and that was followed by a solid 26% gain.
Seriously, let that 70% figure from the COVID crash really sink in for a second. This was a time when the entire global economy literally shut down. The headlines were utterly terrifying. People were completely panicked. Yet, mathematically speaking, it was one of the greatest single buying opportunities in modern financial history. The data absolutely proves that extreme market crashes, marked by these massive spikes in volatility, are historically the exact moments you should be deploying capital, not hiding it under your mattress.
And this brilliantly illustrates our main takeaway for today's explainer. VIX spikes are not signals to sell, they are invitations to buy. By tracking this one specific metric, you essentially reframe your entire psychological approach. You transform market panic into personal profit. You stop acting like the 80% of investors who lose, and you start acting like the smart money.
Which brings us to Section 4, setting your price alerts and turning this theory into action.
Let's move to and see how this builds into a very direct strategy. Here is a pro tip and your immediate homework assignment. Step 1. Go into your brokerage account or finance app right now and set a price alert for when the VIX rises above 30. When that alert goes off, that's your cue to pull up your giant screen watch list of great stocks and get your capital prepared. Step 2. Set another alert for when the VIX rises above 40. When it crosses that 40 line, treat it as your act now signal. The panic is real, capitulation is basically here, and it is time to deploy that capital into high-quality companies at incredible discounts.
I want to leave you with this final provocative thought. Close out your charts for a second and just look around your daily life. Based on what you see, you know how your friends are talking about money, how crowded the restaurants are, the headlines popping up on your newsfeed, what emotion stage do you think the market is in right now? Are we in a state of euphoria, absolute panic, or somewhere in between? Keep your eyes open, track the VIX, and remember, when the crowd is panicking, that is your invitation. Thanks so much for joining me for this explainer, and I'll see you next time.